My name is Michael Guyette, publisher of the Lead Lag Report. Joining me for the air is Mr. Bob Coleman. Bob, introduce yourself to the audience. Who are you? How'd you get involved, interested in precious metals? And what are you doing currently?
Sure. I appreciate you having me back on. I've been a registered investment advisor since 1992. Started a depository in physical metals. Basically, in 2006, I saw the need for physical metals because of the leveraging up in the financial system. And I was looking for an asset class that you could have outside the system or hold in some type of physical form. And the precious metals made a lot of sense back then. So started a depository in 2008. I also run a hedge fund. I've been doing that for a number of years, going all the way back almost to 2002, I believe. But it's designated right now, it's more focused on precious metals, physical metals held outside the system in small deliverable form, and most of the metal. And then also I have a gold and silver sort of transaction service, I guess you could call it. I hate to call myself a dealer because there's such a negative connotation with dealers. So I basically sort of a purchaser representative, I like to call myself, where we basically can get metal for clients at much cheaper levels than what you typically see versus most online dealers and parties out there. So it's really, I've looked at this business from a standpoint. On the depository side, we store a little under 600 million in assets. We have a $600 million all risk insurance policy with Lloyd's of London. We can up that on a phone call. We also we have a fleet of armored transport vehicles that we can also ship outside the traditional courier system if need to. We can insure up to 10 million on the vehicle if we need to do that. But we also have courier policies where we can ship FedEx, UPS, USPS, that type of thing, up to $500,000 per shipment. So we have a lot of logistics sort of avenues that we can provide clients that are looking to get into precious metals, whether they want to store it, whether they want to take delivery of it, whether they want to move it from country to country. We can help with a lot of these different types of I guess, complications or issues that people run into. But the biggest thing is everything we do here at the Vault is fully segregated. It's a very simple process. Basically, client buys it, we store it. We don't do any leasing. We don't do any leveraging. It's a very, very simple business plan, but to me, it's the most conservative or the best interest of the client, because the less the depository has its hands into, or there's just less complications that could arise, whether it be from going concern risk or counterparty risk, conflict of interest, that type of thing. And then we're actually, our depository is one of the only precious metals depositories in the country that's not owned by a gold dealer, a financial institution, or a cash in transit, for example. So we're not a transactional based revenue model, which allows us to store the product and not have to worry about the transactional side paying all the bills. Because if you go through an economic crisis like we went through in 2008, you saw a lot of these armored carriers almost go under because of most of their business is done on transactional basis. 2018 and 19, you saw the industry, which wholesalers and so forth, gold dealers that own depositories, they ran into cash flow issues. They were losing money because the transactional business really slowed down. And that's something that people need to be cognizant of when they're looking at storing, is investigating the facility, how it operates, what's relation to any affiliates, if it's owned by a parent company, what does that parent company do? So I get into a lot of that different stuff with individuals, try to educate them.
Expand on the being outside the system for a bit here, because I think there is an impression by some people that the moment you say that, it almost brands you as somebody who's maybe somewhat conspiratorial. You don't trust the way things are, so you don't want to be part of the existing financial framework. What does that exactly mean to be outside of the system, and what kind of personalities tend to gravitate towards that way of thinking?
It's a good question. The financial system per se is your traditional securities, funds, financial instruments, currency, that type of thing that's held in custodial accounts, qualified custodians, banks, brokerages, that type of thing. That's the typical financial asset model. When you're dealing with physical metal, you can do it in various different ways. Some people, just store physical metal. Some people go into digital metal, where it's backed by tokens or some type of certificate. Others will do allocated programs or pooled programs, where those pooled programs are basically based off the balance sheet of the sponsor. So it's called a balance sheet financing operation, is what I kind of call them. But when you're looking at storing assets outside the system, basically you're taking private property, because that's what physical gold and silver is. It's private property. It can be conceived as a commodity, it can be conceived as a currency, a financial asset, but at the end of the day, it's private property in bearer form. And so the client, when they hold it, the biggest concern is having whoever's holding that any attachment to that metal, if it's on their balance sheet or if it's basically held at a gold dealer. Can the gold dealer touch the metal in any way? As we just saw with First State Depository last year, this may be one of the largest depository losses in U.S. history. From what I understand, there's 40 million in assets that are unaccounted for, that's still going through the receivership, where basically they were storing metal at a depository whose sister company was a dealer. The guy now is being charged along with First State Depository, along with Argent, the dealer, for fraud and a number of other things with the CFTC. But basically, he was taking metals out of people's boxes and basically paying Peter to pay, or taking from Peter to pay Paul. You saw this before. This isn't anything new. You saw it with Northwest Territorial Mint about 10 years ago. You saw it with some other dealers and programs that have went under over the years. It's a big risk when you start storing supposedly outside the system, because when you're outside the system, you're outside a lot of regulatory constraints. So you're really basically dealing with someone on a trust basis, not necessarily one that is, like when you deal with a bank or a broker dealer, there's regulators, FINRA, there's state regulators, SEC. There's a lot of parties that are watching the balance sheet. There's a lot of reports that are brought that are required to be provided as the advertising has to be approved. In the gold and silver world is nothing like that. It is literally the Wild West, and it's buyer beware, and you have to be very careful. And that so what brought me into this business was the idea of storing outside the system was a way to try and safeguard people's assets from not only the risk of a systemic implosion, for example, like we had in 2008, where literally you could have had a domino effect and firms just go one at a time. But it's the ability to, at that point, you can react. Those assets aren't tied. I don't have any managerial control over those assets. The client can come pick them up whenever they want to. It's like storing furniture at like one of those storage units type of thing. So, but in our world of precious metals, most of these depositories are tied in with gold dealers. And the question you have to ask yourself is not only what kind of relationship does the gold dealer have, but how sound are they? How sound is the facility? And there's more nuance to just simply saying, okay, I got a great depository. They're going to store all my metal for me and I'll pick it up 5 years from now. There's a lot of potential conflicts and issues that could arise.
You kind of hit on this point about the regulatory framework and FINRA and all this. So why wouldn't somebody just say, you know what, I'd rather not have to deal with the hassle of the trust aspect, as you kind of alluded to, the wild west of this, and just go with an ETF like a GLD or an IAU? What's the appeal of doing it physically versus having a major institution that has regulation around it be the custodian?
The big thing is ownership. What you're trying to define is the purpose of why you're buying gold and silver in the first place. If it's to basically trade the price, ETFs are probably a great alternative. Futures are maybe a good alternative if you're a professional trader and you understand the leverage that's involved with it. But it's all about ownership and the client's perception of how safe they feel, or how, in terms of how they can sleep at night. The ETFs, what people don't understand about the ETFs is the ETFs is an investment vehicle. You don't own the physical metal. In fact, you don't even legally own the shares. The shares are basically you're a beneficial owner of that. But the client actually, or the investor, is really the product in an ETF. It's not necessarily the ETF itself. And how that operates basically is the authorized participants who work within the ETF. You have the custodian that holds the assets, the trustee that does reporting. You have the authorized participants that buy and sell, basically redeem and create shares. They create and redeem shares based on the premium or discount of the underlying assets in the ETF relative to the share price itself. So in essence, it's a cash flow machine for authorized participants if they can create that liquidity. And so they use the volume activity to basically benefit themselves. And that's great. It's just that you have to understand that you're trading just a paper derivative. You're not really trading, you're not really taking ownership in the metal. In my world, what people are doing when they're buying physical metal is they're saying to themselves, listen, I don't want anybody else's promise to pay. I want to be able to hold this stuff in my name. So if something ever did happen, I can pass it down. I can do estate planning. I don't need to buy and sell this thing if I transfer it to another beneficiary or maybe an heir or something like that. They can do some type of estate planning, which in reality, if you try to take a security, for example, and go through that process, you may have to sell that security, create a tax consequence, or whatever it may be. There may be some different elements involved. Or if you wanted to take delivery from SLV or GLD, for example, and you have the baskets and the full basket, and you want to try and convert that, could that create a taxable event? Or other types of assets or closed-end funds that offer the ability to convert. And there's some popular ones out there that if you do the conversion and you take the physical, that becomes a taxable event. The premiums and the tightness in the market can also play havoc on the overall investment. You may not see the advantage of gold and silver products if you're in an ETF, meaning when Silver Eagles went through the roof last year, people were selling, not just was it, the cost to buy Silver Eagles were abnormally high. It was people were actually swapping out of Silver Eagles into, say, 100-ounce bars and getting an X percentage of more metal for their money. You couldn't do that in an ETF because you're just trading the paper price.
Let's get into that distinction a little bit more, because I've seen that over the years, this idea that, well, that's the paper price, it's not the real price. And to me, it always sounds a little bit odd, but I can understand the thinking a little bit. What does that mean in practice when you hear that line when it comes to silver price, gold price, precious metals in general? Why are there two different prices? How do you square that circle?
I hate the connotation. When you say paper price, everyone watches the spot price. It's not that there's some magical number with Silver Eagles, for example, than there is to a 1,000-ounce silver bar. Everything's pegged off the spot price. It's the trading aspect of how one influences price over the other. So when it comes to futures trading, for example, which has a huge influence over the spot price activity because there's just a lot more paper ounces traded than actual real physical ounces traded, that can have an overwhelming impact on the spot price or the London market compared to the COMEX in New York. And so part of our discussion we had last fall, we were going through the idea of backwardation, meaning, everyone was selling off the metals last year in summer into the fall. On paper, you had CTAs liquidate, Fed's raising rates, they're looking at liquidity, they're just following the playbook of, hey, commodity prices are going to get whacked, if interest rates keep tightening and the dollar keeps strengthening. Well, they went down that and they sold the market down so much that the physical market woke up and started buying. And you had these odd, long-dated backwardations that started to pop up, meaning the spot price of the actual physical metal was worth more than maybe the 3-month lead month contract on gold, silver, platinum, palladium. It actually happened for about 2 or 3 months. It was all 4 precious metals are actually in backwardation. That's a kind of a very rare occurrence. And so it basically kind of identified the selling that was happening was done more on a strategic paper side from a CTA perspective or fund managers versus the actual reality of physical demand for the product, whether it be industry or investment. And so when you talk about, again, paper versus physical in terms of price, the physical players is mainly what they call strong hands. They're in it for the long term. If the price of silver goes up 20%, they're not going to call their dealer and say, listen, sell me out of my Silver Eagle position or 100-ounce silver bar position because it went up 20%. They're holding on to this metal for much longer periods of time, versus the paper trader is typically more leveraged or just more acute to price action. So they'll be very quick on the draw to potentially lock in profits, watching technical charts or some type of developments with commitment of traders, whatever it may be, but they may be much more. And so you just see a lot more turnover. And the problem is it's that turnover that starts to create friction with physical precious metal owners not understanding exactly the entire picture of the entire industry per se, what drives the price. And so you get a lot of and within the physical metal world, you have dealers out there that and promoters that portray the banks as the manipulators, and they're always selling the price down, and they're driving they're driving the price action and pulling the rug. And you obviously you had this case with spoofing last year, and which technically isn't manipulation. It's a management of short-term price action for short-term profits. It wasn't deemed long-term manipulation per se, because there's an intent that has to be basically proven there. But it's a frustrating point because a lot of physical owners just they see the domination of paper trading and the volume of that paper trading as enormous compared to the day-to-day physical activity or the day-to-day market of a physical product changing hands.
Have you seen post crypto blow up and a lot of these exchanges going under in the crypto space? Have you seen more interest in gold since then? I mean, it does seem to be interesting that gold did bottom around the time the FTX kind of blew up.
Yeah, you had sort of a shift into physical metals. I think it did gain some of that support, but at the same time, I think that you saw a lot of startups going into the physical precious metals world, creating tokens and electronic platforms and things like that may have also been impacted by the FTX and some of these other types of tokens that and crypto exchanges that went under. There's certainly a lot more scrutiny out there, and there should be. I mean, because a lot of these programs introduce more risks than I think they actually solve. There's a convenience factor. I get it. I mean, it's nice to be able to swipe a debit card and pay for a cup of coffee or something like that. But there's identifying things within user agreements and structure that these things should be treated basically for the risk that they portray. So if you think about it, it may or something that you could have a month worth of expenses or something like that you can conveniently use, but it may not be a store of value account. So it's just identifying different types of programs for different needs. And I think, especially over the last 3 years, as the precious metals gained in popularity, like any asset class, you have people coming out of the woodworks creating programs out of thin air that maybe aren't as thought through, but the way they're marketed, they market them as, hey, this is like you owning the metal exactly directly without any type of risk whatsoever. It says a completely different story.
Just to reset the room, everybody that's here, please make sure you follow Bob Coleman. Okay, so let's talk about catalysts. So I get the argument of having gold outside the system, having it in these vaults like what you've put together. But from a trading and maybe sort of rather than store value type argument, which we can debate, but from an investment case perspective, has anything changed for gold in the cycle and where we're at? I mean, talk through some of the things that you're noticing that might cause a sustained breakout.
Well, what you're seeing right now, basically, the price move from December into January was really paper driven. The physical market really slowed down, and so the Shanghai Futures Exchange, you had a lot of buying that was going on that was pushing the paper price action higher, and then just as much as that pushes it up, you also had profit taking, and you had a pullback, and you had basically a retracement right from the paper action as well. So you don't see as much physical. It's not like everyone out there is just saying, "Oh my God, silver hit 24. I'm getting out because it's the top." You're not seeing that action. What I think why the market has slowed down on the physical front, one was the premiums were way too high last year, and I think people got burned out, and the premiums have crashed. I was on some Spaces calls back in November and early December saying that the profit margins for dealers have come and gone. I mean, we've seen peak profit margins. Now it's going to start getting a lot tighter, and you see that with some of the publicly traded gold program or gold dealers out there. But I think what's impacting the physical market right now is just simply interest rates have bumped up enough where you can get a 6-month or 1-year T-bill, for example, for close to 5%. So now you have competition with gold and silver that you didn't have maybe over the last 3 years. And that may be simplification of it, but that's slowing the market down. And I think you're probably seeing that in the stock market. You're seeing probably people are saying, listen, why do I need to take this volatility? I can finally earn some money in a 6-month T-bill and wait out the volatility and see where the Fed is and where this where the Treasury may be when the debt limit either gets lifted or it doesn't get lifted. But by June, we're going to know one way or the other if the Treasury is going to go into technical default or not. I mean, there's a lot of things that are just they're still out there that's lurking that is creating some anxiety. But especially last year, everyone went through basically the washing machine cycle 3 times over with the volatility that hit the markets. And it's great that gold and silver actually held up and was silver was actually positive on the year, which you think a lot of people say, well, God, if the stock market goes down, silver is going to follow through with it because 75% of the metals is the demand is industrial driven. So if the economy pulls back or slows down, silver is going to see some of that impact, but it didn't. You had investment flows that were very strong. If the investment flows start coming back into the market, you have a situation right now where inventory is really tight. You only have 31 million ounces sitting on the registered category at the COMEX that backs all the futures contract trading. And now you're getting into March, which is a front month or lead month contract that we're rolling out of. It'll be interesting to see if we get a roll out of March that potentially sees maybe shorts covering and maybe a potential liquidity issue that could ignite the price action to the upside, meaning there isn't a lot of inventory out there. So the people that are short and that have inventory and they're shorting against their own inventory may not want to give up that inventory. They may just be forced to cover. And that's similar to kind of what happened in March and everything shut down and you went to this event where the COMEX saw a $65 jump in price over the London spot price in gold because you had basically a panic to cover shorts and there was just no liquidity on that. And you saw the same thing happen in April of 2011 where silver took off from like 38 or so to $48, $49 an ounce, basically on the roll of those futures contracts and shorts covering. So that could come out of the blue, and that could be the catalyst. You just never know.
I want to expand on the point you mentioned about shorts covering. You often hear that line, I think, especially when it comes to silver, right? This idea that there's a short squeeze, short squeeze, short squeeze. Is there any validity to that, or is that just a narrative that's out there? Is there a lot of shorting that goes on in the precious metals space?
Yeah, you have to understand that the COMEX itself, by design, is a hedger's market. It is a seller's market. It's not designed for the guy who wants to buy metal and take delivery from the COMEX. It wasn't designed that way. It was designed more as from the miners or from the industry's perspective, as a liquid trading vehicle that they can use to hedge the price action of maybe their underlying instrument. So you see, the problem that silver runs into is that when an ounce of silver comes out of the ground, it's constantly hedged from trading party to trading party, meaning the mining company may have to hedge that metal, because of their financing agreements, and when they're borrowing money, for example, to finance their mining operations, they may have covenants they have to follow. Well, then that metal sold to a refiner, and that refiner may hedge the price because they don't want the potential, the volatility to affect their profit margins. And then they sell it to, for example, a wholesaler, and that wholesaler would then hedge that silver while they're holding it, so they don't have profit margin decay on the volatility. And then they sell it to a dealer, and that dealer may hedge on the COMEX because they don't want the price volatility. And so by the time it finally gets to the end user, it may have been sold 5 times on the COMEX, for example, or private party for that matter, OTC, just as a natural, I guess, life cycle of that 1 ounce of silver. And I think that's part of the problem we're running into, is teaching or educating what the COMEX was designed for in the first place. Yeah, well, it's not only that those costs that they're impacting production, but it's also the countries themselves. I mean, you see Peru which is 7%, or no, they had a 7% drop in production. Some of these South American countries and other countries that have political instability is affecting. So you have less silver coming to market. I mean, we saw, and I talked about it last fall where you had some of the miners out there were rolling their forward contracts as the price was dropping below 19 and 18. They were rolling their forward contracts instead of delivering the metal because they were hoping the price would come back up. Because the cost of production in some of these, I think, Steve St. Angelo does some good work on identifying some of these, the absolute cost of production for some of these primary silver producers, and some of these guys are $21 an ounce. And these guys are basically the margin of the market. That may be enough on the margin to affect the price action overall, and that's. So it's not necessarily the 70% of the producers that are using silver as a byproduct. Silver tends to bottom where a lot of these cost of productions tend to fall with some of these primary silver producers. So there is some truth to that. You could have a 2008 scenario where silver goes from 17 or 18 down to 8 or 880 or whatever it was, and just blow through everything, and everyone gets margin called and blown out of their positions. But then the physical guys just start coming back in, and we saw a point after 2009 where it took 4 months to get delivery of anything silver out there. I mean, whether it be any product, it was just absolute madness back then. And you saw the same thing happened a little bit with 2020, 2021, 22 timeframe, where you saw tightness enter into the market, and then all of a sudden, to get product, the premiums were going up because the cost of not only production but the cost of refining and making product actually started rising. Logistics started going up, and you had just the cost for product impact price action as well. You do have position limits with regard to silver on the COMEX. So you can take, I think it was up to 3,000 contracts. They doubled the position limit size, and it's 5,000 ounces per contract. So you would have my math right with me right now, but you may have some calls, from different parties or government officials or regulators asking you why you're taking all this metal. But a lot of instances, you can go to refiners, you can go OTC and do the trade or buy a large amount of silver directly with either bullion banks or other refiners. You don't necessarily need to go to the COMEX. The COMEX just happened to be, the last couple of years, happened to be the cheapest place out there, and actually had available inventory for delivery. And we saw that, and that's why you've seen this continual drain. It's interesting because it could continue to drain because you don't have there's no reason to put metal onto the COMEX right now, because like I mentioned in some Twitter posts, is that the financing costs are higher than the leasing costs or the roll cost or the roll proceeds to constantly, if you put metal on the exchange and you're selling, forward futures contracts and buying them when they get close to delivery date, and you just do that over and over, the return on that's 3.5%, but it's costing you 4.5% for the money in terms of financing costs. So you don't have there's no reason to put that metal on the exchange to do that, borrow money to get the metal to put it on the exchange. So you're kind of caught in this little quandary here where it's almost like a perfect storm that's happening, where there's no incentive to put metal onto the exchange. At the same time, you could start seeing somebody, for example, just start to call basically during delivery month to stand for delivery with their long contract. Now, it's interesting to note that it's the seller, the short, that actually determines if they're going to make delivery to the long. It's not the long that demands the delivery and they automatically get it. So there are some caveats that you have to go through to stand for delivery. Well, if you saw inventory drop like a rock, and all of a sudden you started to see, I would imagine what would probably happen is you'd have some arbitrage situations develop or pricing dislocations develop, where it may start, like, for example, when March of 2020 happened and you had the COMEX, which, you had the gold market $65 higher in New York than it was in London, you're going to have a lot of people take their metal and deliver it to New York and sell against that much higher price. There's an arbitrage there that you can take advantage. I would imagine you would have the same thing happen. Now that may not stop at an initial that price should be countered with whatever arbitrage that develops from that. That's what I kind of see happening. See, basically the market may end up leveling itself out over time, but initially somebody's going to be on the wrong side of that trade. And like we saw in March of 2020, I think it was, some of these like HSBC Bank lost like $65 million in one day just because of that really odd price move. Yeah, you certainly could have that from a standpoint of a situation where basically like last year, refiners were literally pulling metal from the exchanges to deliver back to make product with. That's how tight the market was. I mean, when you had India come in and buy the was it 20 or 30% of the entire silver produced that year? Just an enormous amount of buying activity. That demand pulled a lot of supply from London and from New York, and yeah, you could see that type of squeeze unfold. And that's why again, why I say the people that are short that may actually have metal on the exchange, or maybe shorting the contract against metal, that they may not want to deliver that metal or lose that metal. They may just be using the contract to basically hedge the price exposure. But that has in the past, like you mentioned, nickel, where maybe some of these producers that were using the contracts to protect themselves turns into a hedging nightmare where the hedge becomes a potential huge loss on their books. And as you're short, if you either don't have the metal or you don't want to give it up, you have to close that position out. You don't have a choice. It's just a shame. I'd hate to see the COMEX basically do what the LME did, which was cancel trades and not allow the market to flow freely. But that's part of the problem when you have you use leverage on top of a small asset class that can be dominated very easily by just a couple of large hedge funds taking a 0.1% ownership in silver into their portfolio. It's unreal how small this market is.
I'll take a quick stab at that real quick, Bob.
Sure.
Because I'd even extend that to how can you explain the dollar itself having advanced since QE3 began? Right, because it's kind of a similar argument. I remember back then in late 2012, everyone was saying the dollar's about to tank because of all this, added QE that the Fed was undertaking. So my own theory, and of course it's just a theory, is that when you look historically at various asset classes when the Fed really started QE3 and ZERP, the end result was that you basically had no left tail risk for U.S. equities. That matters in the context of gold, I'd argue, and other commodities in every asset class, in that when you don't have left tail risk, which is what QE3 effectively cut off, it causes momentum players to just play that one asset class. I mean, at the end of the day, everyone has to kind of decide where to put their money to work. And if there's no tail risk on the left side of the distribution, which is what happened to U.S. equities because of QE3 and ZERP, that keeps money out of other areas and prevents momentum from picking up in other areas. I don't know if that makes sense, Bob, but that's always been sort of my hindsight bias on what happened the last decade or so.
Right, and I would add to that, you've seen a lot of derivative creation by the banks like Bank of America, Goldman Sachs, J.P. Morgan over the last few years with silver, for example. Well, they categorized it in precious metals, but that includes silver, platinum, and palladium. You've seen a lot of institutions that may get into silver, for example, but they don't want the physical metal. They just want the paper instrument. They want the security because they, maybe by charter they cannot go into the actual physical metal, or it's just maybe too small. For them, taking a boatload of 1,000-ounce bars isn't their intention when they're running a portfolio. They just want silver as a percentage of their overall commodity basket. And okay, they go to Bank of America and say, okay, create me a derivatives contract, and that money. And you've seen this in the ETF market. There's a lot of ETFs that call themselves a silver ETF that have absolutely nothing to do with the physical metal. There's ETFs that basically buy futures contracts. There's ETFs that will basically have they may do call options on silver, but then put 100% of the assets into a U.S. Treasury and offer some type of yield component, and they call themselves a silver fund, but they have absolutely nothing to do with silver. And that's been one of my frustrating complaints out there, is that there's a lot of creation of securities that just basically act as a sponge that would normally soak up potentially a lot of demand that may come into not only the price but the entire forward curve of silver itself. And silver is one of the only commodities out there that has its own users association. I mean, there's the users out there. Silver is obviously the most reflective. It's the most conductive metal on Earth. I mean, there are certain things that you can't just simply swap or replace with silver. So there is a sort of a concerted effort to maintain your supply of it. But that's the problem. If the price stays down too long, you're going to impact supply. You're going to run into supply constraints and potential deficits like we saw last year. And if those supply deficits continue on, I think ultimately the market wins out.
Maybe for the just last couple of minutes here before we wrap up, again, everybody please make sure you follow Bob Coleman on Twitter. In terms of the way that you yourself are trading, right? So you've got the hedge fund side of things and the RIA side. Are there certain areas that you've been overweighting more this year, the way the year has started? What's going on in terms of your own trades and allocations?
Yeah, the hedge fund I run it's just very simple. I'm a very long-term oriented type of kind of guy. So it's 99.5% roughly of the fund is in physical metal, and about 70% of that is silver, 30% is gold. And I use the gold silver ratio and other types of maybe longer term ratios to try and guide, okay, is one asset maybe overvalued relative to the other asset? And so it's simplistic, but hey, last year the fund was actually up on the year. So I was able to not get too burned by the volatility. But the funny thing is I barely did any trades because I didn't see anything really changing when silver was tanking like it was in the summer and fall, and you saw the backwardation, you saw the dislocation. I was like, it'll pass, but it's showing that there is demand for this asset. Buyers may be waiting and they may be more patient, allowing the price to drop, but they're there and they're lurking. And so as long as you have that, the wind's to your back. If the Fed cranks up interest rates and we go to a massively high real rate of return, that's going to impact commodity flows, and that may. But the problem you have with that scenario is how the hell are you going to continually finance the deficit and debts, and that actually adds the flavor going into the second half of the year when this debt limit ceiling gets lifted. That's going to bring a wave of treasury paper into the market that could actually create volatility and also create more uncertainty. And that should be a tailwind for gold and silver going into 2024, especially coming to the election. You may not have the patience of government going into an election year, if the economy is starting to recede or potentially has the potential to recede. And at the same time, you have treasury debt that's going to be coming to market. Who's going to fund all that? And it may force the Fed ultimately to turn around or maybe stop the tightening process. And that's what the metals, I think, ultimately, the numbers are so large. That's sort of my base case for the metals going forward. You haven't seen the top. You haven't seen the euphoric rise like you saw in Bitcoin or tech stocks or SPACs or some of these other types of instruments that have gone through and gone to meteoric and euphoric positions or price action. You haven't seen that yet, and that's coming, and we'll know it because like we saw in nickel, the same thing will happen with silver, and that'll probably be the spike high, and at that point you got to look for value elsewhere.
I think that's a good place to wrap this Twitter space up. Again, please make sure you follow Bob Coleman. Bob, really do appreciate your entrepreneurialism. Obviously, you've done some phenomenal things in the space. I applaud you for that. And thank you everybody for joining. Thank you, Bob.